Good morning and welcome to Charting the Markets on Monday, the 20th of March 2023. Late last night, UBS bought its beleaguered rival Credit Suisse for around 3 billion Swiss francs, and that equates to around a share price of 76 centimes, which is much lower than Friday's Credit Suisse's closing price of 1 Swiss franc and 86 centimes. Now, the Swiss finance minister also said that this deal was a commercial deal and not a government bailout, even though the Swiss National Bank also provided a $100 billion liquidity line to the takeover deal. Now, the takeover came complete with a complete write-down of Credit Suisse's 16 billion Swiss franc worth of additional Tier 1 bonds. And these riskier notes were basically introduced after the financial crisis in 2008. And it marks the biggest loss yet for Europe's £225 billion AT1 funding market, and had a negative impact on investor sentiment earlier today, with banking shares dropping by up to 6% in early Monday trading, and then coming back slightly, but they're still down by around 19% since the beginning of the month, as investors worry about other banks perhaps being in a similar situation in the next few days and weeks. So the banking crisis hasn't really abated yet, and there might still be further negative impact on the AT1 bond market, because basically, as JP Morgan has said, for example, earlier this day, that even though UBS stood to gain in terms of the long term from the deal, the write-down on the AT1 bonds would impact other European banks. And this is exactly what we saw this morning. And we can have a look at the FTSE 100, for example. Here on the daily financial bet, we can see that we dropped all the way down to 7,204 before trying to recover. But yes, we followed on from the last couple of weeks slide and traded at levels last seen in early November of last year, and are currently still trading below the red line here, which is the 200-day simple moving average at 7,421. And for the bulls to really, short term at least, to be back in control, what we need to see from a technical perspective is a rise and daily chart close above Friday's 7,511 high. Only then could we have some sort of stabilization kick in. But right now, even though we are off the lows short term, the credit default swaps on several banks are still trading higher, showing us that the risk is still very much being perceived by many investors with regards to bank shares. And the reason for this is actually that increased funding costs, tighter regulation, and also lending standards might then slow down growth, and that has a negative impact, obviously, on the economy, on investor confidence, and also earnings and employment and stock valuations, which is why equity markets have come off in line with banking shares over the last few weeks. But let's see where we were to go to if we were to fall through this morning's low at 7,204. Well, the next downside target you have is this uptrend line around the 7,000 mark psychological support, and you also have the early October high at 7,105. So these are potential downside targets. But I wouldn't be surprised now that Credit Suisse has been bought by UBS, and that all the central banks globally are providing much needed liquidity to restore confidence in the financial markets. We could see some short-term stabilization later this week if we were to form a hammer formation as is being formed at the moment today, at the end of the day today, and if we could then rise above these highs we saw today tomorrow. But these are big ifs for the time being. As you can see, the momentum still pointing to the downside, and the same is the case with regards to the DAX 40 contract, because as you can see here, this has slid very sharply all the way down to 14,459, taking us back to levels last seen at the beginning of this year, before then recovering. And interestingly enough, the low was made exactly or within a point or two, of the 61.8 Fibonacci retracement of the entire December to March advance. And from that point of view, technically speaking, if we can close around current levels later today, and this is a big if, we can then rise tomorrow above today's high, which in case of the DAX 40 comes in at 14,942 on this daily financial bed, then we could stabilize and at least short-term head higher again. But we'll really have to monitor this quite closely from a technical perspective at the end of the day today. Moving on to US markets, what we can see there is that the S&P 500 has also come off in overnight trading, despite the Fed last week and several other major investment banks providing liquidity to the markets to basically also help the smaller banks in the US, some of which went bankrupt, as you know, last week, also amid the collapse of Silicon Valley Bank, which is the US's 16th largest bank. Basically has led to some weakness short-term as risk-off sentiment pushed the S&P 500 down after losses having been seen in Asian markets and also earlier today in European markets. But here you can also see we're in the process of trying to form a hammer. We still remain below the 200-day simple moving average of 3,930. And today we would really need to close above there. And ideally also in the course of the next few days above Friday's high at 3,976 on this daily financial bed for some kind of bottom to be able to be formed here. As long as that's not the case, as long as we remain below Friday's high at 3,976, the downside still has very much more favor. As you can see here, we remain in a downward trending channel since mid-February, and we may then slide back again towards the 3,809 mid-March low, and then also that would take us down towards December lows at 3,764. But as I say, short term, it looks as if the bad news, all of the bad news, is out now. Those who had to sell short-term, at least, bank shares have done so earlier today, and we may see bank shares recover slightly, and with that also the indices in general, not just in Europe but in the US, over the course of the next few days. But we'll have to see whether technically that's actually the case or not. But that doesn't mean that from a medium-term perspective the banking crisis is over. The takeover by UBS, Switzerland's largest bank, of the beleaguered second largest rival Credit Suisse, has led to the US dollar weakening slightly, and then earlier today actually strengthening because of flight to quality flows as equity markets in Asia and in Europe continue to slide, especially with banking stocks being hammered. I mean, the Euro Stoxx 600 banking index, for example, in early morning trading on Monday morning slipped by about 6% before recovering. But that had led to some short-term flight to quality flows into the US dollar, which have since abated. As you can see here on the daily euro dollar chart, we did dip down towards 106.31, but then started to rise again with the euro rising and appreciating versus the US dollar. And now the cross heading back up again towards the February to March resistance lines, which comes in around 107.30. So that's the short-term upside target for euro dollar, followed by 107.60, which is the mid-March high. Now that needs to be taken out along with the mid-February high at 108.04 for a bottom to be confirmed from a medium-term perspective for euro dollar. We are not there yet, but these are the technical levels to watch out for with regards to the medium-term trend, because as long as we stay below 108.04, further sideways trading may be seen, as we have seen over the last 3 to 4 weeks, really, between the sort of 105 handle and the 108 handle. But short-term, it looks as if euro dollar is still pointing higher. With regards to the euro against the British pound, however, this has slid this morning as the euro fell on the back of European banks continuing to be sold off by market participants. But here also you can see we stabilized above the mid-January low and also last week's low between 87.22 and 87.19. Minor support we held above there earlier today, and euro sterling is now recovering with the euro in view of banking stocks in Europe also recovering, as this early morning selling has now abated, at least short term. We'll have to see whether the European markets can then continue to rise on the back of US markets coming in later on with regards to equity indices. But all of this has also an impact on the risk-on, risk-off sentiment, which then also impacts the US dollar. Now, with regards to euro sterling, we can see that we may today retest the 2-week resistance line around 87.90, and above there we've got some minor resistance at the mid-February low at 88.03. And then you've got really important resistance at Wednesday's high at 88.43. We would need to rise above here for us to then bounce back towards the upper range we've seen between 88.97 and 89.78 over the last 3 months or so. Moving on to the Japanese yen, we can see here that the Japanese yen has has appreciated versus the US dollar. You can see here dollar yen sliding earlier today to a low at 103.54 to levels last seen on the 10th of February of this year. And here we could, if we were to fall through today's low, slide all the way back down again towards the 10th of February low at 129.81, below which we also have the February low at 128.08. And for the bulls to be back in control, we really need to rise above our last reaction high, which is quite a long way away at Wednesday's high at 135.11. So even if short term we want to bounce back, it would need a much stronger push in the US dollar to take us above this 135.11 high seen on Wednesday for us to then regain our upside momentum. But right now, downside momentum seems to be really having the upper hand with regards to dollar yen. Moving on to commodities, these have been quite mixed. I mean, you can see the price of oil on this risk-off sentiment globally has come off very sharply. And when we look at WTI, we can see here that we've broken out of this wedge formation we've been mentioning for the last 3 months or so, and slid all the way down to earlier today's low at $64.37. As investors are increasingly worried about the banking crisis having a negative impact on the economy, because obviously it will most likely increase funding costs for banks, lead to tighter regulation and also to tighter lending standards, which can then slow down loan growth and thereby then economic growth. And obviously slower economic growth weighs on confidence, weighs on earnings, weighs on employment and also stock valuations. And this has then also had obviously a negative effect on the economy in general. And that's why we have had the price of crude oil fall very sharply. And we'll have to see what the next technical downside level is, because you can see if I zoom out here, WTI, the next level below the current $64.37 low is really seen at the December 2021 low, back at $62.35. So that would be the next technical downside target. Resistance short term comes in at the December 2021, the late December 2021 low at $66.10. And then we've got really good resistance at $70.25. But you can see here, price of crude oil looking quite negative. Now, the opposite of this has been happening with regards to the price of gold. Because of all this global risk-off sentiment, the price of gold has briefly risen above the psychological $2,000 per troy ounce mark. Earlier today, it went up on this daily financial bet to $2,009 per troy ounce, and that takes us back to levels last seen in March of 2022. So 1-year highs in the price of gold seen on the back of the earlier this morning risk-off sentiment seen in equity markets. But with equity markets potentially stabilizing short term, it's possible that we may well retest the February high at $1,959 per troy ounce with regards to the price of gold. And we may then, if equity markets were to calm down and to recover somewhat, we may then slip further with regards to the price of gold and head back down towards last Wednesday's high at $1,937 per troy ounce. For a bearish reversal to really take shape with regards to the price of gold, we really would have to fall below Wednesday's low at $1,886 per troy ounce, and we are a long way away from there. So short term, yes, we might see some sort of profit taking here, but medium term, the picture is still looking bullish with regards to the price of gold. And interestingly enough, I'd like to finish up on silver, and you can see here the silver price has broken out of a downward trending channel. It did so last Monday. Swift acceleration to the upside, taking us earlier today to $22.71, back to basically resistance last seen on the 23rd of January, which currently caps the price of silver. And again here, if the risk off sentiment we've seen earlier today were to abate, we could see a retest of the $21.50 area over the next few days this week, perhaps take shape. And below there, we've got the 200-day simple moving average coming in $20.95, which is another potential support level. But it looks as if the price of gold and silver, short term at least, might stall today and tomorrow perhaps. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is AxelR_IG.